Hello, everyone. Welcome to video 6 of Module 1, Chapter 1. In this video, we're going to be discussing net income and how we actually calculate the net income based on our income sources. So, the first thing to be aware of when calculating net income is net income can only be positive or zero. You can't have a loss, or you can't have, yeah, you can't have a loss in the Tax Act because there's no such thing as negative taxes. If I lose money in a year, so after the course of a year, if we calculate all my income and my deductions, I actually have a loss. That amount becomes zero, and that loss will be held onto until I earn income again. And then I can subtract that loss against the net income. So when we're calculating net income, it can never be below zero. Negative numbers are ignored. If negative, use nil or zero. Income is always a positive concept. So reference to employment, business, or property is a net concept. So gross income minus the allowable expenses related to that source. So I can only deduct from my business income business expenses. I can't deduct my property expenses from my business. I can't deduct business expenses from my employment income. You have to match the expenses to their associated income sources. Income Tax Act 3 is the section of the Tax Act that discusses net income. So we'll go through Tax Act 3 portions, but I think if you're just aware that Income Tax Act 3 is where net income is discussed, is probably enough for you to satisfy the expectations of an introductory course. We're not going to ask you to regurgitate, lines or paragraphs from the Tax Act. So, subdivision A or subsection A includes positive amounts of employment income, business income, property income. It does not include losses from employment, business, or property. So if I have a business, I've earned some income, but I overall have losses, I will not subtract it from the A section of our calculation. I'm going to subtract it later. The first thing we want is just the positive amounts. So subsection B talks about capital gains. So now that I've got my source incomes included, employment, business, property, I'll then calculate my taxable gains. So we want to have our taxable capital gains minus our allowable capital losses. Now, if our losses are greater than our gains, then our overall net capital gains is zero. Those net capital losses, that additional negative amount, will be held onto and applied against a future year that does have capital gains. Stated alternatively, allowable capital losses can only be deducted by the extent that we have taxable capital gains. So if I have 10,000 of capital gains, of taxable capital gains, and 5,000 of allowable capital losses, 10 minus 5, $5,000 of taxable capital gains will be added to my return. If I have $10,000 of taxable capital gains and 25,000 of allowable capital losses, I can only subtract up to my 10,000, up to the existing taxable capital gains I have. So 25,000 minus 10 means 15,000 of allowable capital losses will be carried forward or saved until we have gains in a future year. Um, subsection C is looking at certain expenses we can subtract from income. So less division B, moving expenses, childcare cost, RSP contributions. So we may just say the subdivision C expenses are, $6,000, or we might say they have moving expenses of 1,200, they have childcare cost of 4,000, they have RSP contributions of 800. We can combine these amounts and subtract them from our income that we're calculating. This amount will be positive or nil. It can never be negative. A negative expense doesn't exist. If I have moving expenses that somehow made me money, that might somehow be a new source of income if I'm charging people to move me somehow. So expenses are never negative, we are subtracting positive expenses. And so after we've included our incomes, included our net capital gains, subtracted those subdivision E deductions, now this is when we will include losses from employment, business, or property. If my only source of income is employment, and then I do all the calculations, and now I have business losses, I can subtract them off of the tail end of my net income. This will become clear when we get into the examples. So if your resulting net income is positive, that's your net income. We will report and pay taxes on that amount. If it's not positive, it's negative, then our net income is zero. Net income can never go below zero. Employment income will include salary, wages, stock options, less certain deductions, and we'll discuss those like wage and salary, pardon me, inclusions in chapter 3. Employment income is usually only given to individuals, and it's rarely negative. If you have continuous employment, it's very rare that your automobile and home office expenses will be more than your employment amount. Business income has inclusions related to carrying on a business, such as sales or service fees, less your business expenses. Now, anyone can partake in business, so this can apply to individuals, corporations, and trusts. Property income just depends on who owns the property, can also be individuals, corporations, and trusts. Property income is most often rent, dividends, or interest, but it can be other types of income like royalties and license fees. Expenses are similar to those used to determine business income. They're similar to business income, but there's usually fewer of them because it doesn't usually cost as much to maintain property income. This discusses capital gains and losses. The most important thing to remember about capital gains and losses is that they're only included in income at 50%. So if my capital gain is $100, my taxable capital gain is $50, half. If my capital losses are 15,000, my allowable capital losses will be 7,500. Your taxable and allowable amounts are always half of the total. Allowable capital losses can only be deducted against taxable capital gains. We can't subtract it from other types of income. If our allowable capital losses are more than our taxable capital gains, that means we have a net capital loss. They create a negative. So that will be held on to apply against capital gains in a later year. I don't think we're going to throw too much of pension income and spousal support, but pension income, spousal support, and social assistance payments, these are specific income types identified separately in the Tax Act, so they don't fall into those normal income source clauses. Now, these additional income types mainly apply to individuals. They do not relate to specific sources of income. So RSP contributions, childcare costs, moving expenses can also be subtracted from these types of income. Okay, so here's the little flow chart on how we do the net income calculation. So we start at A, add your worldwide income from employment, business, property. B, add the taxable capital gains less allowable capital losses. C, subtract any deductions like childcare, moving expenses, RSP contributions. And D, that's when we will subtract our losses from our income calculation. So it looks like this. So we have employment income, 25,000. We have a business loss of $4,000 and taxable capital gains of 7, allowable capital losses of 20. So we'll start with our employment income of 25,000. Our taxable capital gains was 7, but our allowable capital losses was more than our 7. So that number becomes 0, and that difference of $13,000 will be held onto for a future year. So when we add 25,000 plus 0, that's 25,000. We have no subdivision deductions, subdivision E deductions. We had a business loss of $4,000. So once we get to the next step, that's when we can subtract our 4,000. So our net income is $21,000. So that's the example from the slides. We have 3 exercises to get to, 16, 17, and 18. For the current year, Mr. Norris Blanton has employment income of $42,000, a business loss of $15,000, taxable capital gains of $24,000, and subdivision E deductions of $13,000. What is the amount of Mr. Blanton's net income? Now, the key thing to know here is they tell us that these are the taxable capital gains. Since they're giving us the taxable amount, we don't need to half the $24,000. They've already given us, this is half of our amount. So our total capital gains must have been 48,000. So they've given us the taxable. So we start with our positives, our incomes. We had 42,000 of employment income. They didn't tell us any other amounts, so we leave it there. Our taxable capital gains was another $24,000. So our total income so far is 66. That 42 plus 24. We have subdivision E deductions of $13,000, so we can then subtract that 13,000. Our 66 moves to 53, and then we had a business loss. So our business loss was 15,000. So that 53 minus our business loss, our net income is $38,000. So that's our calculation. That's how we get to the Division B income. So $38,000 is the overall income for this person. How do they say it? Yeah. That is the overall net income for the current year. I think we're going to complicate this somewhat. For the current year, Miss Stoddard has interest income of $33,240. So we're given a positive. So we know we're going to start with it in the top of our calculation. Taxable capital gains of $24,750, allowable capital losses of $19,500. They've given it to us as taxable and allowable, so we don't need to do a half amount. If they didn't have taxable, if they just said capital gains of 24,000, we would have to half this amount. We'd have to apply 50%. But they're giving it to us as taxable, so we can just use the number as it appears. And a rental loss of 48,970. What is the net income for the current year? Do we have any loss carryovers? So we started 33,240. That was our interest income. Our taxable capital gains was 24,750. And from this number, we can subtract our allowable capital losses. So our net capital gains was 5,250. So that can be added to our 33. That's 38,490. We weren't told of any deductions, but we were told of a rental loss. 38,490 minus 48,970, our subtraction is larger than the income we've recorded so far. So we have a loss, but net income can't be negative. So it becomes zero. And that difference of $10,000 will be carried forward as a non-capital loss. The reason we differentiate between capital loss and non-capital is because capital losses can only apply against taxable capital gains. So this number has to wait until we have capital gains in the future to subtract it. This number can subtract against any income we have next year. So we had overall a loss this year. So we have a non-capital loss carryover of 10,480. Our last exercise, 118. For the current year, Mrs. Marie Bergeron has employment income of 42,680. So we have a positive. Taxable capital gains of 27,400. Allowable capital losses of 33,280. We can see our allowable capital losses of 33,000 is more than 27. So we're going to have an allowable capital loss or a net capital loss to be carried forward. Subdivision E deductions of 8,460 and a business loss of 26,326. So we have our income, we have our net capital gains, we have subdivision E deductions, and a business loss of 26,000. What is the net income? Are there loss carryovers? So we have net employment income of 42,680. We have taxable capital gains of 27. allowable capital losses of 33,280. So since our losses are more than our gains, it's going to be zero. So our net income's only that employment of 42,680. This difference of 5,880, this difference in this allowable capital loss, will be carried forward. 42,680 minus our 8,460 for our subdivision E deductions leaves us with 34,220 minus the existing business loss of 26,000. We have a net income of 7,894. If our business loss was much higher, let's say it was 46,000, this negative amount, this negative 12,106 becomes zero, and we can have both a non-capital and capital loss carry forward. So just because we have one type doesn't mean we can't have the other type. It just matters whether this nets to zero or if our overall calculation nets to below zero. Okay. So for your use, the end of this exercise sheet has just sort of a blank income. So you can go through some practice questions, make some up on your own, and you can help use this to derive your own net income calculations. Until then, I think I have one more. Is there one more exercise? 1920? Oh, that's just talking about tax planning. Yes, in the next video, the last video of chapter 1, I will go through some tax planning concepts. But until then, thank you for your time, and I'll see you in the next video.